Hello everyone, I myself Rashmi Pandey back with next part of my video, that is some basic concepts. In my earlier video I have discussed about the concept of 3Fs, that is flow, variable, final goods and factor income. Now in this part of the video we shall discuss about some other important concepts of macroeconomics. So first of all, I will discuss about the concept of investment. For a common man, investment means simply putting the money in the bank and getting interest over it. But actually, investment in economics is different from this concept. In economics, investment means addition made to the stock of capital goods such as building, equipments, inventory of goods during a given period of time. Investment in economics is addition made to the capital goods because they increase the productive capacity of the economy. They help in production, they help in increasing the production. That is why if a stock of capital goods is increasing, that is called investment. From the given definition, we can find out two components of investment. So first component is fixed investment and the other one is inventory investment. Now we shall take up both of these one by one. Fixed investment is expenditure made on purchase of fixed assets like building, machinery, equipments, etc. Means whatever expenditure is made on such assets which do not change, that is called fixed investment. And other one is inventory investment. Now we will take types of investment. There are two types of investment. First one is gross investment, which includes replacement cost for wear and tear. Why it is called gross? Because investment includes fixed assets which depreciate. And on the other hand, the other one is net investment. What is net investment? When the cost of replacement for wear and tear is not included, that is called net investment. So we shall see what is the difference between gross and net investment. Net investment is equal to gross investment minus depreciation because fixed investment includes fixed assets which depreciate due to regular use. From this we get the next concept, that is concept of depreciation. Depreciation means reduction in the value of fixed asset like machinery, building, equipments, etc. due to regular use. That is, consumption of the value of fixed asset in the process of production is also known as consumption of fixed capital. Why it is so? Because fixed assets depreciate their value, means their efficiency does not remain same for all the time. They cannot be used for much longer period of time, though they are for longer period, but when we use them, their productivity decreases. That is one of the cause of depreciation. Now we will see what are the reasons of depreciation. First one is normal wear and tear and the second one is expected obsolescence. Now what is normal wear and tear? Normal wear and tear, at your home you must be having mixer and from them when you have brought it, maybe sometimes there is a breaking of jar or anything, so that needs repairing. Same is the case of fixed asset, that that wearing out of fixed asset is one of its feature, and sometimes accidental damage decreases its productivity. That is called normal wear and tear. Because repairing work that does not recovers the machinery, okay, so its value, what happens, that depreciates. Now second one is expected obsolescence. Sometimes what happens that that technology becomes old, as due to which demand of product decreases. So that is either due to change in demand or technology, the value of fixed asset decreases, which is called expected obsolescence, as you can see in the given picture. First one is roll camera, another one is digital camera. Most of you must have not seen this roll camera, or some of you must be having it at your home, but that is no longer in use because rolls are not available. Digital camera are more convenient, so people are nowadays preferring this digital camera. That is new technology. Due to old technology, roll cameras are not used. So that is called expected obsolescence. Due to expected obsolescence, sometimes what happens, that value of a fixed asset decreases. That is one of the cause of depreciation. Now we will see what is the difference between capital loss and depreciation. These are two different concepts. Capital loss takes place sometimes due to some accident or some calamity. Okay, and consumption of fixed capital, that is reduction in the value of fixed asset due to regular use. So they are totally different. Capital loss means loss in the value of fixed asset. Its value totally loses due to some unexpected obsolescence, natural calamity, theft or accident. And consumption of fixed capital, as I have done it earlier, that it is reduction in the value of fixed asset due to regular use. When it is used regularly, what will happen? Its value will depreciate. That is called consumption of fixed capital. Now from here, we move towards our next concept, that is factor cost versus market price. Now, what is factor cost? It is expenditure made by a firm, that is payment made by a firm to the it is all payments made by a firm to the factors of production for their contribution in the production process. That is, it is sum of rent, interest, profit, etc. Means how a firm produces. It produces with the help of factors of production, and whatever payment is made to the factors of production, their sum for a firm becomes factor cost. Whereas the market price is different from the factor cost. How it is different? The commodity is not sold at that price at which the product has been manufactured. When it comes in the market, government imposes some tax that is included in the price of the commodity, and that is called market price. So what is the difference between factor cost and market price? Market price is equal to factor cost plus net indirect taxes. What are net indirect taxes? Net indirect tax is equal to indirect tax minus subsidy. When the product goes in the market for sale, government imposes some tax like GST on the commodity, which is included in the price of the commodity. Okay, whenever a tax is imposed on a commodity, that is an indirect tax, because direct tax is directly imposed on individuals. And sometimes what happens, government provides subsidy for motivation. Okay, so this taxes increase the burden and subsidies decrease the burden. So their difference is called net indirect taxes. Okay, so market price includes net indirect taxes and factor cost does not include net indirect taxes. Now we move towards our next concept, that is net factor income from abroad. What is this? Net factor income from abroad is income received by factors of payment, factors of production which work outside the country. Okay, sometimes what happens, our residents work abroad and some foreigners work in our domestic territory. So whatever payments are received by these factors of production, their difference is called net factor income from abroad. It is FIRA minus FIPA, factor income received from abroad minus factor income paid abroad. CSO has defined it differently. It is income attributable to factor services rendered by normal residents of a country to rest of the world, less factor services rendered to them by rest of the world. Now components of NFIA, there are three components. First one is net compensation of employees. Second one is net income from property and entrepreneurship, and third one is net retained earnings of resident companies abroad. Now we shall take up all these components one by one. So first one is net compensation of employees. What is compensation of employees? It is that payment which is made to the employees. They get salary, they get their traveling allowance, they get house rent, uniform allowances. Their sum is called compensation of employees. So when someone works outside the country and whatever payment he gets, its sum is called net compensation of employees. Some foreigners are working in our country and some of our residents are working abroad. So their balance is called net compensation of employees. So it is sum of the income earned by normal residents of a country by working in domestic territory of other countries. As you can see in the given picture, there are many people. Some are foreigners and some are Indians. Whatever payments they must be getting, that their difference is called net compensation of employees. Now the second part of net compensation, that NFIA, that is net income from property and entrepreneurship. As you can see in this net income from property, it is an income. Okay, where from the income is coming? It is coming from property and entrepreneurship. Property means house or some other land if anyone is having, and he is getting some rent over it. Okay, so that is income from property. And sometimes people have financial assets like bonds, shares, etc. Whatever income they are earning over this, okay, that is called net income from property and entrepreneurship. If any resident is having his house abroad and he gets rent over it, and any foreigner is having his house here in India and he gets rent over it, so their difference will be called as net income from property and entrepreneurship. Okay, this is one of the part of net factor income from abroad. Now we move towards the third, that is net retained earnings of resident companies abroad. Coca-Cola, a US-based company working in India, and Indian company Reliance and SBI, they are having their offices abroad. Whatever profits they are earning, their undistributed profit, its difference is called net retained earnings of resident companies abroad. As you can see in the given picture, SBI Canada Bank means SBI is having his branches abroad. So whatever earning they are getting, whatever undistributed profit they are earning from abroad, it is called net retained earnings of resident companies abroad. Okay, now we move towards our next most important concept, that is gross domestic product. In short, we call it as GDP. So GDP is sum of monetary value of all final goods and services produced within domestic territory of a country in an accounting year. What does it mean? It is sum of, total of what? Monetary value of whose? All final goods only. In my first video, I have told you, in national income, we add only final goods, not intermediate goods. Okay, so final goods are added only in the GDP. Goods and services which are produced, where these goods and services are produced within the domestic territory of a country, when they are produced in an accounting year. So total 6 parts we get in GDP. That is, it is sum of monetary value of all final goods and services produced within domestic territory of a country in an accounting year. Now in this definition, the most important part is domestic territory of a country. Now what is the meaning of domestic territory of a country? A common man in general will assume that political borders of a country form domestic territory. But in economics, domestic territory is broader then this one. So we will see what is domestic territory of a country. So first of all, political borders, including territorial waters and airspaces, they form domestic territory of a country. Political border, you understand, boundary line, whatever we are having. Then territorial water, what does it mean? 20 nautical miles from the coastline in the ocean area or sea area, that is called territorial water. And airspace, above it we have airspace. So that is domestic territory, and if any income is generated within this domestic territory, that will be a part of our gross domestic product. Now the second one, that is important. What is domestic territory? That is domestic territory, if we see, it is ships and aircrafts operated by residents of a country between 2 or more countries. Ships and aircrafts, they are operated, they regularly visit other countries, and if any income is generated in that ship or aircraft, that will be included only in our gross domestic product, not in other countries' gross domestic product where they are going, because they are regular movers. Now third concept, that is fishing vessels. Fishing, fishermen catch the fishes, and whatever income is generated in this fishing vessel, that is included in the country to which that fishing vessel belongs. Now oil and natural gas rigs operated by residents. What are these oil and natural gas rigs? There are centers where oil and natural gas is available. So if it is within the domestic territory of the country, that will be included in our gross domestic product. Now the next one is embassies, consulates and military establishments located in other countries. Embassies, where our ambassadors live, wherever they are located, in which country they are located, it does not matter. If an Indian embassy is located in USA, that income which is generated in that embassy, that will be presumed as GDP of India. Whosoever is working there in embassy, whether an Indian or an American, that income will be included only in our GDP. In the same way, military establishments are also located many in foreign countries, and whatever income is generated in these military establishments, that is also part of our domestic territory. Clear? Now we move towards our next concept, that is the concept of national income. National income is a little broader concept than the gross domestic product. According to CSO, it is sum of factor income earned by normal residents of a country in the form of wages, rent, interest and profit in an accounting year. Again, we can divide it into 6 parts. What is it? It is sum of. Whose sum? Factor income, as you know. Then earned by whom? By normal residents of a country in the form of wages, rent, interest and profit in an accounting year. Means it should be a starting point and it should be an end point. That is the accounting year, and it is sum of whose? Factor income only. I have earlier told you that transfer payment is not added. So factor income is an earned income, and who earns it? That is only by the normal residents of a country. And in what form it is earned? It is earned in the form of wages, rent, interest and profit, because all these are factor payments. Okay, wages are given to labor, rent is given on land, interest is paid on capital and profit is given to entrepreneur. So all these are factor incomes, and when are these measured? That is in an accounting year. Now in this one, we have one most important concept, that is normal resident of a country. Now we have to see who is seen as normal resident of a country. Normal resident, normally you will be thinking that anyone who lives in the country, he is a normal resident of a country. If he is a citizen or a foreigner is there, he is not a normal resident of a country. But actually in economics, it is different from the definition of citizen. Meaning of normal resident of a country, he may be a person or an institution. An institution is also presumed as normal resident of a country, not only a person. And he can be a citizen or non-citizen. You will be thinking, how non-citizen? A person, non-citizen, who normally resides in a country for more than 1 year. He is assumed as normal residents of a country. And his center of interest should lie in that particular country. Suppose a foreigner is living in India for more than 1 year, then he will be presumed as normal resident of India. Who lives, I've told you that more than 1 year in that particular country, he will be presumed as normal resident of that country. So normal resident can be a person other than a citizen. A citizen is normally a normal resident, but a non-citizen who is living more than 1 year in a country is also seen as normal resident of that particular country. Now, out of these, we have to see that who are not normal resident of that particular country. Now, not normal resident of a country. If a person who lives for less than 1 year, he is a foreigner and lives for less than 1 year, he will not be presumed as normal resident of a country. Foreign tourists, border workers, what happens? That foreign tourists come for some time and they go back. So they are not normal resident. Border workers regularly visit the one country to other. Means they come in the morning and they go back in the evening. So they are not normal resident of that country to which they visit. They are normal resident of that country in which they live. Okay? Because they are not living in that country. Then officials, diplomats and members of armed forces of foreign country. Suppose armed forces are having their military bases somewhere else and they have gone there, and whenever they come back, because they are regular employee of our country, so they will be presumed as normal resident of our country, not of other countries. Then bodies of international organization. If WHO is having his office in India, then that will not be presumed as normal resident of our country. That is presumed as normal resident of international area. Then crew members of foreign vessel, seasonal workers of foreign country. Foreign vessel that visits our country, they may be coming for some time and they will go back to their own country. So they are not normal resident of our country. They are normal resident of their own country. Then medical patients and students remain resident of their own country irrespective of the time they live abroad, because they do not earn anything. They come for medical treatment and study. So they cannot be assumed as normal resident of our country. Okay? They are normal resident of their own country. That is the basic difference. So this part of the video